In this video, we will discuss a key concept in corporate finance, the time value of money. This principle is strictly tied to investment decision processes, since it lets you calculate present and future values of cash flows. Let's first define what we mean by time value of money. Time value of money is a key principle in finance. In a nutshell, it states that money today is worth more than money tomorrow. There are three reasons why that is so. First, people prefer present consumption to future consumption. They prefer the egg today rather than the chicken tomorrow. So in order to give up present consumption, they demand more money or a premium in the future as a form of compensation. Second, monetary inflation erodes the value of what you can get by the same amount of money as time goes by. In other words, the higher the inflation rate, the higher the difference in value between money today and money tomorrow. Third, uncertainty, also known as risk, plays a role. In fact, if future cash flows are riskier than present ones, people will value future cash flows less than present ones. That's because they are not certain. The discount or the interest rates factors in all these elements. It measures the rate at which present and future cash flows are traded off against each other. The discount rate is an opportunity cost, which is the potential return an individual is missing out by not investing money today in investments with a similar risk and return profile. Let's just pause for a second here to try to understand this relationship, since it is a milestone in the theory of corporate finance. The discount rate embodies the reasons why money today is worth more than money tomorrow. This parameter is used to discount back to the present the value of future cash flows arising from an investment opportunity, or to compute the future value of a present value. The beauty of finance is that we can travel back and forward in time, just using the discount rate to convert present value into future values and vice versa. The higher the discount rate, the lower the present value of the investment. Why? Because there are good investment opportunities available at present, thus the high discount or opportunity rate that we are missing out. Therefore, the discount rate expresses the opportunity cost an investor is bearing by deciding to put his or her money in a specific project today. More specifically, the opportunity cost represents the rate of return an investor could have earned on an alternative investment with a similar risk and return profile. Now that we know what the discount rate and opportunity cost are, it's time to understand how to calculate present and future values. But why do we need them in the first place? Present and future values are necessary to compare cash flows arising at different points in time. This is possible by applying the so-called time value of money principle. To better grasp these concepts, let's go through a simple example. Suppose you are entitled to €100 at the end of year 1. The discount rate is 7%. To get the present value of this future cash flow, you need to divide it by the discount factors as shown in the formula. Now, let's suppose you have $100 today and the compound or interest rate is still 7%. By investing $100 at 7% for a year, the future value will be 107 as shown. But what if we need to calculate the present value or the future value of different cash flows in multiple years? It's easier to grasp this concept again by visualizing cash flows on a timeline, highlighting when cash flows arise through time. Assume that in the next 4 years you are entitled to a stream of annual cash flows. To know how much these cash flows are worth today, that is their present value, we need to sum them all up. We cannot do that straight away because they arise at different points in time, and thus it's as if they are expressed in different currencies, to which we need to apply a foreign exchange rate to convert them all in the same currency. In this case, our exchange rate will be the discount rate and our final currency will be money today at present time. By applying a discount rate to cash flows arising at different points in time, we bring them all back to the present. Cash flows further away will be worth less and less because all of the risk associated with the passing of time, deferred consumption, inflations, and uncertainty. Mathematically, we account for this fact by the exponential function applied to our discount rate. There is a 1 in front of it to make sure that discounted cash flow will be worth less than undiscounted or future ones. Starting from present values, we can derive a formula for future values as well. In this case, rather than dividing cash flows by the discount rate to bring them back in time to the present, we need to multiply them by the discount rate to bring them forward in time. Intuitively, if you assume positive interest rates, the further away we go, the greater our cash flow will be. Why? Because we are investing money for longer, earning more interest on our initial cash flows. Mathematically, as we just saw for the present value calculation, we use the exponential function. To sum it all up, present value is the current value of a future sum of money given a specified interest rate. Future value is the value of a current sum of money in the future based on a specified interest rate and investment horizon. In order to decide whether an investment project creates economic value, analysts and managers use a concept called net present value. It works just like the present value principle we saw before, by discounting back to the present a future stream of expected cash flows, both positive and negative. However, it also considers the initial outflow of money necessary to start the investment, subtracting it from the discounted future cash flows arising from the investment itself. Only projects with a positive net present value should be started, since cash inflows generated by these projects will exceed cash outflows associated to them, once they have been properly discounted, of course.